Okay, well, the purpose of this video is to illustrate the differences between investing for cash flow versus capital appreciation. Now, concepts of risk management will also be discussed because they're paramount to the importance of becoming a successful trader. But first, let's define the difference between cash flow and capital appreciation. And I have to warn you that my definitions will be different than those you've been taught in school or have learned from your financial advisor. Now, to illustrate my point, let's take a look at a capital appreciation as defined by Investopedia. So capital appreciation here is a rise in the value of an asset based on a rise in the market price. All right, well, before we go any further, if you're dependent on the market prices always going up in order to make a profit with your investments, then you're probably in the wrong place. You know, for me, a better definition would be a rise in the value of an asset based on a favorable move in the markets. Now, a sophisticated investor does not depend on market direction to profit, but rather the movement of the market itself. Now let's take a look at cash flow investing here. Cash flow investing is defined as an item on the cash flow statement that reports the aggregate changes in, well, I'm not going to go through all of this. I'm just going to tell you basically what I look at when I'm investing for cash flow. Now, cash flow investing, as I define it, is the regular withdrawal of profits realized from an investment to minimize the risk and recapture at least 100% of your initial investment. Now, that's my definition. You can define it however you'd like, but I'll go over why that's important in a minute. Now, when you realize 100% of your initial investment and pull it off the table as a profit, then you've successfully realized an infinite return because you're realizing cash flow from an asset where none of your own capital is at risk any longer. Now, many people may argue that that infinite return on your money is impossible or that this type of investing is risky, but many of these people are the same ones that have been earning commissions on feeding you this information for years. And now I'm going to let you decide on that. Well, once again, my definition of cash flow investing is the regular withdrawal of profits realized from an investment to minimize risk and recapture at least 100% of your initial investment. Well, let's take a look at some investments here. Now, I've got, and I could pick any one of these different charts to get this data, but you're looking at here, you're looking at monthly returns, okay? And then I've created a spreadsheet. I've just copied and pasted this information. Here's from a performance report, the max drawdown, and that's trade close to trade close. So that's close trade drawdown. And then I've made some spreadsheet with some calculations here. And this first one we're looking at is capital appreciation. I'm going to tell you how I do this, and then you can create your own rules, but I'm just going to show you how I do it. First, you take your initial investment, you determine your proper position sizing, you determine risk per trade, which we've gone over in previous videos. You look at your maximum drawdown adjustment, and that's just, you're looking at this figure here. Your maximum drawdown is $6,625.80. Okay, I take 1.5 times that because we're moving forward in time. We don't know for sure what the markets will do. I like to leave a little bit of extra room. 1.5 times the max drawdown is what I'm willing to tolerate as far as a loss. So if you take this maximum drawdown, which is 6,625.80, and multiply it by 1.5, your maximum risk in investing 50,000 should be less than 10,000, or just around 10,000, or $9,938.70. And that is it's easier to risk 10,000 than 50,000. So if you start with an account of 50,000 and it draws down $10,000, I would stop trading. And so this is capital as it's appreciated over time. So this is investing for capital appreciation, not cash flow. So if you're trading this system, and this is non-compounded returns, this is just trading a single futures contract, non-compounded over time with $50,000, you should see your equity start to increase over time. As the equity increases, you follow that up with the max allowable drawdown, which is calculated at simply by taking the profits that are realized and subtracting this $9,938.70. So you'll find that on the months where there is a loss, instead of decreasing decreasing your max drawdown. You leave it at the same level. So when you realize losses, you don't lower your max drawdown rate. You leave it right there. And that's why I allow 1.5%. Now, the problem with capital appreciation investing, in my opinion, is that you're never reducing your risk. In fact, your risk increases as you move forward in time. And you'd say, well, you've got this max drawdown level. But the problem with most investors is they never know when to quit. And so when we go into a recession, we found that a lot of people lost 50 to 60% of their account value. I've got people in my family who did that. And so that's why, if you're trading and don't know how to take profits off the table, I say that your risk increases over time. And you can disagree with that. But if you can follow these directions, you should limit your loss so that after about 5 or 6 months on this plan, if you pull the profits off the table, if it ever hits this line, then you shouldn't be risking any money at all, because you've made more than $10,000 in profit. And that max drawdown line has never been hit in this case. Now, let's take a look at cash flow investing and see what the difference is. Now, for cash flow investing, what I typically do will pull profits off the table, generally on a monthly basis. So each month, as profits are realized, as you can see in this blue line here, if you start with 50,000, if there's first month is $3,111 in return, I'll pull that off the table and I'm left with a $50,000 balance at the end of the month. This is very simple to do, because you don't have to recalculate every month like you do in this case. But using a spreadsheet, it should be easy if you decide to trade for capital appreciation. But in any case, for cash flow investing, at the end of every month, if you've got in your account more than you started with, you just remove that amount of money. And so over time, you'll see that there are profitable months where capital is taken off of the table, and then months where there is a drawdown, where you don't remove any, but just leave the account, recapture that money over time. And sometimes it takes us a couple months, as in the case here, for that lost money to be made back. And that's perfectly normal. But in this case, with cash flow investing, a couple of things are happening. Your equity is not increasing quite as quickly as it would with capital appreciation. That's true. But your risk is going down as these profits are taken off the table. So in this case, at less than 2 years, this is 21 months in, you have eliminated your risk, because all of the money that you put in has been recaptured and pulled off the table. So at this point here, infinite returns essentially can take place, because you've removed all of your money and now still control this cash flow from this investment. And as it grows and grows, you can control the rate of its growth by determining how much you want to pull off the table at the end of each month. But by investing in this way, your risk, in my opinion, is minimized. Your cash flow can continually increase after you get this point of infinite return as you let your account grow. So your income doesn't decrease over time, it actually increases over time. So that's the difference in the way I define capital appreciation investing versus the cash flow investing. And I think it's important for me to share that with you so that you can have a different perspective from what you may have heard from school or from your financial advisor. So that's it for this video. Thanks so much.